Picture this. It's a Tuesday afternoon, the kind that feels ordinary, almost sleepy, but for some, it's anything but. Barry, a regular trader tucked away in his spare room, is glued to his screens. Coffee in hand, he's watching every tick, every chart, betting big that the Reserve Bank of Australia will keep rates steady. He's done his research, read the forecasts, and feels confident, maybe even a little invincible. The clock hits 2:30. Suddenly the RBA shocks everyone. Rates go up, defying the predictions and sending a ripple through the market. Barry's screen turns red in an instant. The Aussie dollar rockets, his stocks nosedive, and the numbers he's been watching all day start to blur together in a sea of losses. He's just learned the hard way how a single central bank decision can wipe out months of careful gains in a matter of seconds. The market doesn't care about his plans. But Barry's not alone. Across Australia, thousands of traders scramble every time the RBA speaks. Some are seasoned pros, others are just starting out, but all are at the mercy of the same announcement. These boardroom decisions send shockwaves through markets, dictating fortunes with a single announcement. The fate of portfolios, big and small, can change in a heartbeat. For traders, it's a high-stakes game, guessing the next move of the financial bosses. Every word, every hint, every pause in a speech is analyzed for clues. The mood of the market, the direction of stocks, even the fate of a Tuesday afternoon, all hinge on a few words from the central bank. It's a reminder that the market is always listening. It's not just about Barry's bad day. It's about the power the central bank wields over everyone in the market. No one is immune, no matter how prepared they feel. Every announcement is like waiting for a reply to a risky text. Will it be good news, bad news, or just silence? The anticipation is electric, and the outcome can change everything. For traders, the RBA's word is law. Get it right, and you're celebrating. Get it wrong, and you're scrambling to recover, making frantic calls and second-guessing every move. In trading, you're not just up against other traders. You're up against the biggest player of all, the central bank. Their decisions shape the entire playing field. That's the lesson Barry, and every trader, learns sooner or later. The market is a teacher with no patience for ignorance. Ignore the central bank, and you're just asking for trouble. In the world of trading, staying alert to every signal isn't just smart, it's survival. So what is a central bank? It's a question that might sound simple, but the answer is surprisingly important for everyone, whether you're a business owner, a student, or just someone buying groceries. Think of the economy as a giant, unpredictable car, and the central bank as the driver keeping it on the road, navigating sharp turns, sudden stops, and unexpected bumps along the way. In Australia, that driver is the Reserve Bank of Australia, or the RBA for short. It's the institution at the heart of our financial system. Their job? Keep the currency stable, unemployment low, and the economy healthy. They watch over the flow of money and try to keep things running smoothly for everyone. They're the financial grown-ups, controlling how much money is in the system and making sure banks play by the rules. They set the tone for how money moves in Australia. You can't open an account with them. They're a bank for banks and the government, not for everyday people like you and me. Their main enemies? Inflation. When prices rise and your money buys less than before, and unemployment. When jobs disappear and people struggle to find work. Balancing these two is a constant challenge. For traders and investors, understanding the RBA's next move is critical because everyone in the market, from big banks to small investors, has to follow their lead. How does the RBA steer the economy? It's a question that affects every Australian, whether you're a homeowner, a business owner, or just someone with a savings account. Their main tool is the official cash rate, the interest rate banks use to lend to each other overnight. This rate is like the heartbeat of the financial system, setting the pace for borrowing and lending across the country. Change this rate, and it ripples through home loans, savings, and business borrowing. Suddenly, your mortgage repayments might rise or fall, and businesses may find it easier or harder to get loans. If inflation's too high, they raise rates to cool things down. making borrowing more expensive and encouraging people to save rather than spend. If the economy's sluggish, they cut rates to spark spending, hoping to boost confidence and get money flowing through shops, cafes, and businesses. Sometimes they go further, using quantitative easing, creating new money to buy government bonds and flood the system with cash, aiming to lower longer-term interest rates and encourage even more lending. These moves can jolt the economy like a defibrillator, sending shockwaves through markets and households alike. Every rate change is a signal to the markets. Speed up, slow down, or brace for impact. Investors and analysts watch these decisions closely, knowing they can shift fortunes overnight. For traders, reading these signals is everything. It's a high-stakes game of anticipation and reaction, where timing is crucial. Miss the cue, and you're left behind, watching opportunities slip away as the market moves on without you. For traders, RBA announcement day is like a season finale, full of suspense and risk. Preparation is key. They scour every speech, every hint, every economic report for clues. Inflation and unemployment numbers are watched like hawks. Traders weigh the market's expectations, sometimes following the crowd, sometimes betting against it. The biggest moves happen when the RBA surprises everyone. When the news drops, it's a race. Algorithms and humans alike scramble to react in seconds. In this game, speed and insight mean profit or pain. When the RBA moves, the Aussie dollar and the stock market react instantly. Higher rates attract foreign investors, pushing the dollar up. Lower rates send it down. A strong dollar hurts exporters but helps travelers.